I think is great about Osage is how on the first page of our SIM, the confidential information memorandum, we put the owner's goals on the cover. And that gives a lot of choice. So if the person says, look, I want to take some money off the table and work for 5 more years, the smart private equity investors or even the smart strategic investors stop and say, I'm going to create this dream job for you because it'll ensure that your goals are aligned with my goals for the next 3, 5, 6 years, whatever it is.
Hi, everyone. Welcome back to our podcast, The Ins and Outs of Selling Your Business. For those of you just joining us today, my name is kdee, President of Osage Advisors. Osage Advisors is a boutique merger and acquisition firm founded in 2001, primarily working with business owners looking to sell. Our typical client has $5 million in revenues and up. And we're excited today to bring back one of our own team members, Will Wilcoxson. Hey, Will, good to see you again.
Hello, Keith. Thanks for having me.
Well, we appreciate you taking the time. I know you got a lot on your plate based on a few calls we had yesterday and day before. So thanks again for being here. For those of you who may not have seen our last episode, Will brings a unique perspective to our business. He spent the bulk of his career funding companies in early stage and startups. And now he's working with Osage, helping business owners exit their companies. Our typical clients are near or at retirement age and looking to transition into, over time into a different lifestyle, right? Next stage of life, whether they're turning it over to family members, whether they're selling out to a private equity fund, a strategic buyer. It's a really emotional time for our clients. And our job as advisors at Osage is to help them transition on their terms. And Will, so it's a whole new ballgame for you working on the sell side. And I'm sure a few things have come up that have surprised you when the business owner is ready to sell. And I'd love to get your perspective on some of the things that we've dealt with as a team and you individually with our clients. Helping them through that process. If you can give a few examples or just your thoughts on that, be great.
Sure. Well, and thank you again for that introduction. As we talked about last time, the difference between the venture-backed companies, the biggest difference, and say a lower mid-market company that's possibly family-owned or closely held, is that the venture-backed company was built from day one to be sold or to be taken public. So they're investing in a lot of money in sales and marketing and product development and, getting the word out and so forth. And generally, since they were engineered from the beginning to be sold, when it comes time to sell, they're usually looking at the highest price and they have the champagne bottles ready to pop open once the deal is closed. However, when you go to the closely held and family businesses, as you mentioned, it's very emotional. And, as the founder of a business, I may not have had a real boss in 30 years. And when I go to sell, there might be an earnout period and I might be working for somebody half my age and not making all the decisions. And that can be daunting. And one of the things I think we've seen is that more frequently than not, the buyers at Osage the winning bidders are not always the highest bidder, and that people are looking to take care of their management team after they sell. They want to be taken care of. They may want the name to be on the wall. They may insist that the buyer doesn't move the location or lay off people for a period of time. And those things, usually when they get those concessions, it's at a slightly lower price. So the emotional part, it plays a big role in how the exit is done. Because if the owner isn't happy with what they're being offered, they might just say, no, I've done this too long. I'm not going to take a suboptimal, outcome. So,
right.
I might not sell. So I think that's the biggest difference.
Yeah, I think it's understanding. It's also understanding the market, right? Understanding the buyer pool. And, for an Osage, and I know our whole team adheres to this, is that really understanding why they're coming to us. What's motivating the sell, and what are your goals and objectives, right? I mean, you could be the second generation and the third generation still working in the business, but you decided that, hey, I need to provide for myself and my spouse, so I need to sell. Or maybe I'll sell a recap. I'll sell out a big piece, but leave some in for my kids to continue to run because that's what they choose to do. Or you may have one kid in the business or a child in business that wants to stay on and grow it, and another person, a child in business who's not in the business, but is also looking for a payday. So there's a lot of dynamics going on. And in the meantime, like you said, you have your whole identity wrapped up in this company, as you should. So, understanding the market, understanding what the buyers, how they perceive your business, both good and bad, and then providing them with these choices of different buyers. Because most of our clients, I would say 90%, maybe 95%, this is the first and only time they're going to sell. So when you're talking to the buyer, when you're talking to our client, the seller, and you're advising them, things kind of pop up that you may say, okay, I didn't see that coming, right? And I'd love your perspective on how, all of a sudden, you were surprised. You had a great deal. We vetted the market. We talked to, 15 different buyers. We came down to a handful. We got down to the table, and then all of a sudden the client's like, I can't do it, right? It's like, not because of the price. It really, like, the number two reason deals don't get done is because the buyer remorse, seller remorse, cold feet, right? So, we've been in that situation. I'm sure other bankers have been in that situation that don't work for Osage, but how do you work through that situation to get to a point where, hey, this is a good deal for you?
Yes, and I don't think there's any simple answer. I think it's like, it's a professional relationship. You really get to know what their interests are, what their motivations are, sometimes what their fears are. I know a lot of times, I've done a lot of work with behavioral health companies. And a lot of times you have a provider, a person who's providing, say, physical therapy services. And when they started the business, it's because they had an idea for a better way to treat your patients. But at some point, it stopped being fun. They're dealing with payers and they're dealing with HR issues, and so they want to sell, but then they just can't. They'll articulate, "Oh, I'm not sure what I'm going to do." And one of the good things about the private equity recaps is that a lot of these small clinicians, or $2 or $3 million businesses, the owner wants to take money off the table, but they want to basically have an easier lifestyle. So rather than working 70 hours a week, the smart private equity owners will say, "Look, I want to keep you on because this is continuity. So I'm going to buy half of your business now and provide the capital to run your business. But you know what? You don't have to worry about billing issues or payer issues or HR issues. All you're going to do is, for example, hire and train, or go out and call on, pediatricians for referrals. And once they're working fewer hours and they're having more fun and not doing the nuisance stuff, they stop and say, this is what I want to do for the next 10 years. But if it's just, hey, we're going to go out and sell the business, and, you're going to go for long beach walks from this point on, that's daunting. And that's why what I think is great about Osage is how on the first page of our SIM, the confidential information memorandum, we put the owner's, goals on the cover. And that gives a lot of choice. So if the person says, look, I want to take some money off the table and work for 5 more years, the smart private equity investors, or even the smart strategic investors, stop and say, I'm going to create this dream job for you because it'll ensure that your goals are aligned with my goals for the next 3, 5, 6 years, whatever it is.
Yeah, so it's a good point because what you're talking about there, it's a lack of better, it's like a soft landing, right? You are able to take some chips off the table, but you're also able to continue working on the things you like to do. And
yes.
in all honesty, sellers, that's a win-win in the right circumstance. That's why we vet the buyer pool and have them do their own due diligence on the buyer pool and make sure to talk to other companies they bought, CEOs of the companies, see how things transition, how things work for them. But from a buyer perspective, I think sometimes our clients maybe don't think about this enough, is that the buyers really want you to stay on in a capacity. Whether you're driving sales, whether you're driving, a pet project, whether you're driving acquisitions. I mean, what we typically see is when one of our clients sells, most likely from a private equity perspective buyer, the first thing they ask is, who else should we be talking to in your network, right? Because you have relationships. You've walked to trade shows for 20 years. You know your competition better than we do. Who else do you think we should be talking to, right? We want you to kind of drive that activity. But in the meantime, you've taken a bunch of chips off the table, diversified, your risk, and you still have rewards that you can spend the next couple of years doing if you choose. It's your call, right?
Exactly, and I think also, a lot of times, to the point you made earlier, the technology CEO may have built and sold 3 companies before. This is something they know about, and in the smaller business owner perspective, they don't really know what they're encountering, and the fear of the unknown is huge. So they might picture that all investors are going to be these tyrannical folks who are demanding performance, and then when we get them 7 or 8 indications of interest, and they decide who they want to meet with, they usually come out and they say, I really like these guys. They may not be the highest bidder, but I think that the chemistry with me and my team is going to be the best. I think that my customers and clients are going to be taken care of. And that's sort of part of the discovery process, because, chemistry is everything. And if you're working with good investors or a good, acquirer, your life is going to be a lot better, and your outcome is probably going to be better than if you're working with somebody who provided the highest price, but you don't exactly see eye to eye with them.
Yeah, it's a good point, because I think, you use chemistry. I always use the word fit. Is it a good fit, right? Does it work for us? Does it work for you, right? When I mean us, I mean the family. And
right.
As you said, multiple winners of our auction process have not been the number one price. In fact,
right.
We've had situations where the top bidder, when they came into manager meetings, our client would look at them, and after a meeting says, look, I'm not doing a deal with these guys. I just don't like them. I don't trust them. Right. So now we've selected that buyer, right? Our client selected a buyer with our advice, and we're moving forward. And then we get into, the due diligence phase. They're going to basically, look under the hood: financial, operations, sales and marketing, personnel, you name it, human resources, cybersecurity, goes on and on and on, right? And that's when, I think it really becomes real. And we've experienced this on multiple occasions together already. And is that, I use the word deal fatigue. Is that as time wears on, patience, emotions run thin, and little things come up that could, let's say, kind of strain the trust factor that they initially had. And we've experienced that, good and bad, with clients that just couldn't get over it and clients that did. So, but that's just the nature of the business. But from your perspective, and we went through this together about a year ago with this particular client, and I think you did an incredible job of laying the facts on the table. But at the ultimate day, it's their final decision. And I just get your perspective of, how you went about that, from a standpoint, it's like we don't work like you got to do this deal, right? It's like,
Right.
okay, what do we need to do to satisfy your concerns so you're comfortable, right? That's how we approach it. So I just love to hear a little bit about from you. When you think about that from all your training, all your investing, everything you've done from your prior experiences, and now you're here trying to, nurture your client to do the right thing, but they got to make that call themselves.
Right. And that gets back to the owner's objectives. And I think what happens is when somebody is just running their business day to day and they're not thinking about, at some point I'm going to sell, they put all this stuff off. And when you have that conversation about what would you really like to do, that's, I think, when you get to the heart of the issue. And if somebody's like, I really want to continue to work for 2 years, or I really just want to get out of the business in 6 weeks. When you have those conversations up front and you put a good explanation, when you address the owner's goals and interests in the write-up, you get buy-in. Because if it's something that someone says, once and it's sort of passing while they're thinking about 10 other things, that's not really a serious commitment. But if you're having 2 or 3 conversations over the space of time when they're contemplating this and they continually say the same things, you get a good sense that, they've thought about this, they're committed to it, and they're not taking it lightly. And that's, I think, the real difference. And Keith, you and I have met a couple people in the past who had nice businesses, and they were, good people, but we could tell that they were ambivalent, right? And nobody wants to get down the path of working for 6 or 9 months if someone isn't really committed. So I think I've learned a lot from you, because I think that you've been able to sort of tease out some of the inner thoughts that maybe don't necessarily come out, to really get a sense for whether the person is serious about it, or, is this a real deal killer, or is it something that I can live with? And there's no substitute for just developing that relationship and understanding really what's making somebody tick.
Yeah, I think that's an important point. You want to have, we always say before we sign up a client, we want to be of like minds, right? We spend a lot of time up front, being totally honest about what we perceive the value of the business in the current market. And we've been doing this for over 20 years, so we have a good sense. We're not going to be spot on, it's going to be this number, but a range, likely trade between X and Y. And if the potential client agrees with our thought process on that, then we move forward. But we've turned, as you said, business down because their valuation expectations are not what we consider in market. And we don't want to go out there and say, hey, yeah, we will take you on as a client, and this, by the way, we're not going to get that price. You got to take this price. That's a lose-lose situation, right? So that is something that, is I think you really got to focus on, is make sure that there's a buy-in on both sides, because we're a team. We're going to be their partner for the next 6 months, 9 months to a year, working with them to liquidate their most value, their biggest asset, whether it's partial liquidation, full liquidation. So we want to make sure up front that we're on the same page. And then on the other hand, it's also about continued communication, right? I think that our job is to communicate the concerns of our client to the buyer, no matter how small, because of the concern of our client, it's big to them, even though you may perceive it as inconsequential. It's not really going to affect the price, and it may not have anything to do about the price, right? It could just be about how I feel working with these people moving forward. There's a million things that are going through a seller's mind when you get close to close, and also from communicating the buyer's concern to our client, because we got to find a middle ground that we all can work with. And that's, that could be a lot of conversations going back and forth, as you and I have experienced in the past, to get to a place where everybody's comfortable, right?
Right.
So.
Right. And I think that part of that is being as upfront as possible, both in the confidential information memorandum, as well as in discussions and the Q&A sessions that we do with owners, to get everything out on the table. Because if, for example, I say in the information memo that our lease is up in a year and we think we're going to get better terms, and we would prefer not to move, but here's our plan in case it happens. If during the process the landlord says, hey, we're not going to renew, or we're not going to renew on favorable terms, you've already described that as an issue, and the potential buyers will say, oh, well, we knew that was an issue, and we'll help you find new
Right.
real estate. If it comes up and nobody's warned you about it, you stop and you say, hey, how big a problem is this? Because I'm thinking about it for the first time. And, more importantly, what else is going to happen, right? Because nobody likes surprises. And when you get one, you always expect there to be another one right behind it. So
Yeah.
I think just the, complete transparency throughout the process is really important.
Right. And I think you hit it on the head right there. Complete transparency is critical to a successful deal, because if there's something out there, it will come up. And if it comes up and you don't disclose it, meaning us, a client to a potential buyer, the skepticism meter goes up. And if that goes
Right.
up, that means the value goes down. And whether they look to say, okay, we see what you're saying, but instead of paying you X at closing now, we're going to pay you Y. And then if you hit that target, we'll pay you the rest in an earnout, right? But if you fully disclose it up front, total transparency is key to success of any transaction, because it will come up.
Yes.
At some point in time. So as we wrap things up, you've been with Osage for what, 2.5, 3 years now? I can't remember. It's been
Yes.
seems like yesterday. Anything you want to share about some of the experiences you've had with meeting potential clients we're working with right now, et cetera, as you have transitioned from the venture world to the M&A world?
I think word we talked about earlier was patience. And, if you're a business owner, you've been running a business for 20, 30 years, you've probably put off, your thoughts about selling the business. I know one owner, great guy, he's of retirement age. He's hoping that his daughter will take over the business, but he doesn't want to force her hand. So he's sort of waiting. And if you go in there with a hard sell and say, you got to do it now, you got to do it now, you got to do it now, it's going to turn that person off. They're not going to want to work with you. And I think, when you say, look, I'm willing to help you, even if you're not thinking about selling or not thinking about selling for 2 or 3 years, I could probably give you 2 or 3 pointers that, when it is time to go to market, that will result in more money in your pocket. Customer concentration being probably the most common thing. You've built a business, you got a customer that's maybe 20% of your revenues, and buyers look at that and say, hey, this guy's probably your friend. So, we buy you on day one, and maybe that person walks. But if the owner has that conversation 2-3 years before, and they make a conscious effort to diversify so that they don't have customer concentration, hey, well, that's that value added. And if you find out, instead, the day that you go to market, it's a surprise and it's going to affect your valuation. So I think establishing contact and rapport with owners early in the process, giving them the benefit of your experience, really paves the way for a good long-term relationship. And I know, Keith, you've met with companies that weren't ready, and then, 7-8 years came back, and you had great experiences. But it's all about patience and being there to help the owners.
Right. And on that note, right, patience is a virtue. You can't force the hand of somebody who's not ready. Our job is to guide them and be there when they're ready to sell the business, and guide them through the process. So Will, thanks again for being with us today. It's been great, and I'll be seeing you in a couple weeks, I think, up in a seminar we're putting together in New Hampshire. So appreciate your time, and thanks again. So everybody,
Well, Keith, thank you very much for having me.
Well, it's been a pleasure. So, again, everybody, thank you for joining us today. To learn more about Osage Advisors, please visit us on the web at osageadvisors.com. If you have any questions, you can feel free to email me at kdee@osageadvisors.com, or feel free to pick up the phone and give us a call at 860-767-3273. Thanks for your time and have a great day.